Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Waitr stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Waitr is a store-to-door delivery service. Another service they provide is when you're sitting at a table in a restaurant, you can take a picture of a QR code with your phone. You will then be redirected to an app with the restaurant's menu so you can order food and drinks. This helps the manager of the restaurant because they can manage things a lot more efficiently. The restaurant saves money on payroll because less waiters or waitresses are needed. Their main business is the delivery service. Especially now with COVID, lots of restaurants are shut down. They have 3 apps called Waitr, Delivery Dudes, and Bite Squad. You can order anything from those 3 apps and have it delivered to your home or work. Different types of businesses would register with these apps to be part of their delivery service. You can simply go on the app and order food or drinks from restaurants. You can also order food from grocery stores. You could order alcohol from liquor stores. You can get cannabis delivered to you. So there's so many options, not just food. Another nice feature is the app tracks the status of your order, also the status of your driver. And the app also stores previous orders for ease of use and convenience. There is a lot of competition in this space like Uber Eats, Grubhub, and DoorDash. Also, many restaurants or food chains like Domino's have their own food delivery app already. If a business is looking to increase revenue, it could be beneficial to be on as many apps as possible. Although, if a store has enough demand on its own app or website, then it would not want to join Waitr and give away some of its revenue. Waitr also earns revenue by connecting businesses with payment processing companies. The payment processing company earns transaction fees every time a business processes a credit card payment using their software. Waitr acquired Pro Merchant and Cape Cod Merchant Services in August of this year. When a business joins one of Waitr's apps, Waitr tries to get that business to process their payments with Pro Merchant or Cape Cod Merchant Services, so Waitr can earn additional revenue and fees. Waitr also acquired Delivery Dudes in March of this year. In 2018, it acquired Minneapolis-based Bite Squad. 2019 was a tough year for this company, so they decided to revamp the executive team. The founder and CEO stepped down, as well as the CFO. The former CEO of iPayment became the new CEO of this company. The first thing he did was exit 70 markets the company was not profitable in. He focused on 700 small and medium-sized markets that were more profitable. Waitr cannot compete with big companies like Uber Eats and Grubhub, especially in large cities, so their focus is in smaller rural areas with less competition. The second thing the new CEO did was lay off all of its drivers and move to a contract-only model, similar to Grubhub and DoorDash. Now they have independent contractors instead of W-2 employees, which saves them lots of money. Their revenue went up slightly from 2019 to 2020, but their expenses were dramatically lower, so they had positive net income for the first time in 2020. Waitr was funded by a SPAC, a special purpose acquisition company is formed to raise money through an IPO, then acquire a private business to help them go public. This is also known as a reverse merger or reverse takeover. In 2018, the merger was completed and Waitr received $308 million in cash proceeds. The SPAC that acquired Waitr was Lancadia Holdings. Waitr is headquartered in Lafayette, Louisiana, and was founded in 2014. It trades on the Nasdaq, Deutsche Börse, and Börse Stuttgart. Let's get started with the model. This is a microcap company, 111 million market cap. They're trading at 77 cents a share, and they have 144 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They only had positive free cash flow in 2020. The other years it was negative, although it's a pretty small negative in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. That is positive now with the big changes the new CEO made. Revenue is the sales for the company, and that grew a lot from 70 million to 190 million, although it has come down from 2020 to the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that peaked in 2020 at 95 million. Below that is their operating expenses, and these are all the expenses not directly related to generating the revenue. And below that is their operating income, which was positive for the first time in 2020, also positive in the trailing 12 months. So you can see what a great job the new CEO did. Their revenue went up slightly. It went up 13 million from 2019 to 2020. But their cost of revenue went down 38 million, and their operating expenses went down 65 million. That is so impressive how much he improved their margins. Below that is the interest they pay in their debt, and then other income and expenses. These are all of the gains and losses not part of their normal business operations. You can see there was a big write-down of 194 million in 2019. I would just focus on operating income. I would usually ignore most things in other income and expenses because they're not recurring. They're usually one-time events. Below that is their pre-tax income, then their taxes, and the bottom line of the income statement is their net income. Their pre-tax income was negative 290 million in 2019, but they're reporting $81,000 of taxes. When you pass through an impairment, whether it's a goodwill impairment or asset impairment, that does not help your taxes. If they had negative 290 million of pre-tax income because they lost a lot of money on their everyday business, that would help their taxes and they will get a tax credit. But impairments do not help your tax bill. So it is good to see they finally have positive net income in 2020 and the trailing 12 months. This is their income statement from their latest quarterly report. This is the first 9 months of 2020 versus the first 9 months of 2021, the third quarter of 2020, and the third quarter of 2021. In the midst of COVID, their revenue was really high in the third quarter of 2020 at 53 million. It has come down as we open up more in the United States. This company focuses only in the US. Almost all their revenue is from transaction fees, but they are receiving more in the other bucket. When someone uses one of the Waitr apps and they order food, drinks, or anything, that person is charged a fee in addition to their order, and that's the fee Waitr receives. So that's where most of their revenue comes from, that fee for each individual customer when they order through one of their 3 apps. The reason their other revenue went up 20x from under 100,000 to 2 million was from the acquisition of Cape Payment Processing. When Waitr refers a business to Cape, so Cape can do all that business's credit card processing, then Waitr receives a fee. And the more volume that business does, the higher the fee Waitr receives. There are also additional bonus fees that Cape pays to Waitr. Their largest expense is operations and support to manage the apps. That's 25 million, down from 27.4 million. Their marketing went up a lot from 3 million to 5 million. R&D went from 800,000 to 1.3 million. General and administrative, which is payroll for support functions, that went from 11.3 million to 10.8 million. And depreciation and amortization went from 2 million to 3 million. So their expenses are pretty much flat from the third quarter of 2020 to the third quarter of 2021. So that's not so great with a lot lower revenue to have the same amount of expenses. So they have negative operating income in the third quarter of 2021, but these numbers are much, much better than their 2019 financials. They paid 1.8 million of interest on their debt, which is lower than the third quarter of 2020 of 2.1 million. And they had a gain of 16 million in other income and expenses. That's why they had positive net income in the third quarter of 2020. I would just focus on operating income when I look at the income statement, not net income. It was the same deal in the first 9 months of 2021. They had positive net income because of a gain of 11 million. The gain in the third quarter of 2021 was related to the acquisition of Cape Payments. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates or loses from its operational business. So you could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. They spend a few $1,000,000 every year on CapEx. That's mainly on the technology for their apps. Operating cash flow minus CapEx gives you your free cash flow. And they had positive free cash flow in 2020, negative in the other years. They're using debt and equity to fund their business. They added $93 million of debt in 2018 and $50 million in 2019. They have been paying down debt in 2020 and the trailing 12 months. They added over $100 million of equity since 2019. And the reason they're adding so much debt and equity is to acquire other businesses, in addition to funding their own business. You could tell because in the investing cash flow section, it was negative $200 million in 2019. And CapEx is part of investing cash flow, and it was only negative $3 million. So the rest was probably acquisitions. Same thing in the trailing 12 months, their investing cash flow was negative $35 million. Their CapEx was negative $9 million. So the other $26 million may have been an acquisition. This is their operating cash flow section from their statement of cash flows. This is directly from their quarterly report, the first 9 months of 2020 versus the first 9 months of 2021. And the way you calculate operating cash flow, you start with your net income, then you have to add or subtract the non-cash items on the income statement, then adjust for changes in working capital. So we start with the gain of $2.9 million. We add back stock-based compensation of $6 million, depreciation and amortization of $9 million, and then we have to adjust for changes in working capital. There was this big negative $17 million in accrued medical contingency. That was the main reason their operating cash flow was negative, even though they reported an accounting profit of $3 million. Usually operating cash flow is higher than net income, as you can see in 2020. They had $30 million of operating cash flow. That means they generated $30 million of cash flow and reported a $13 million accounting profit. This is from the company's quarterly report. It says the company identified and corrected an immaterial error related to the understatement of an accrued medical contingency. $17 million is not immaterial, especially with this company. They say the company became liable for the claim due to the insolvency of a previous workers' compensation insurer. On their 12/31/20 balance sheet, they have $17 million in medical contingency claim. I'll show you their balance sheet in a little bit. This all stemmed from the death of an individual in August of this year. The individual who died, their family members sued this company and also sued Waitr's insurance company. So the loss to Waitr was $423,000 as of September 30th. And this includes medical expenses and dependent death benefits. The woman who died was Georgia Stewart. Her car was hit by a Waitr delivery driver, and she subsequently died in the hospital. It mentions here a 78-year-old grandmother who died the next day. She would still be alive if the company had adequately reviewed the driver's driving record, insurance coverage, and the roadworthiness of his vehicle. On the 12/31/20 balance sheet, they had $17 million in their long-term liability section for accrued medical contingency. Now they have $53,000. When you reduce a liability on your balance sheet, that's a cash outflow in your operating cash flow section. When you increase a liability, that's a cash inflow. They decreased their liability, so that's why it was a cash outflow on the operating cash flow section. It's the opposite for an asset. When you increase an asset, like inventory, it's a cash outflow. When you decrease an asset on your balance sheet, it's a cash inflow. This is a bit confusing, and I'm not sure I understand exactly why they did this. Meaning, I'm not sure exactly why they reduced their liability from $17 million to $53,000. I'm going to email the company and hopefully I get a response. This is their investing and financing section from their statement of cash flow. The first 9 months of 2020 versus the first 9 months of 2021. The top of the investing section is purchase of property and equipment. That was $700,000 in 2021, about $1 million in 2020. Internally developed software was $6.4 million. They did 2 acquisitions in the first 9 months of 2021, Delivery Dudes and the Payment Processing Company. In their investing section, they had a cash outflow of $33 million. Last year was a cash outflow of $3.6 million. In their financing section, they received $8 million from the issuance of stock. Last year was $48 million. They paid down $15 million of debt. They borrowed $5 million of debt. They paid down $5.6 million on an insurance loan. When a company gives stock to its employees, That's a non-cash item because they don't have to pay for stock. It just dilutes the current shareholders. But they do have to pay taxes. So it is a cash outflow in that sense because they have to pay taxes on the stock that they give to their employees. So they paid $900,000 of taxes. So in the financing section, they had a cash outflow of $8 million. Last year was a cash inflow of $22 million. Let's look at the equity section on their 9/30 balance sheet. They have $120 million of equity. They raised $480 million from selling their business, and they lost $360 million from running their business. Let's look at the capital structure. $118 million of equity, $89 million of debt. They're 57% equity, 43% debt. And I gave them the highest whack according to Finbox at 13%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4. That's $488 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $346 million. We divide that by 144 million shares. And we get a calculated stock price of $2.40. They're trading at 77 cents, so they're trading at a 68% discount. It's a buy according to the model. Their revenue is projected to increase 1% annually. So to calculate their future revenue estimates, I increased it 1% per year for the next 4 years. To calculate their future free cash flows, I needed to see what percent of their revenue I should convert to free cash flow. The average company in their industry converts 25% of their revenue into free cash flow. I multiplied their 2024 revenue by 25%. That's how I got their future free cash flow for that year. I multiplied their 2023 revenue by 12.5%. I assumed they would break even, have no free cash flow for 2022. I don't think these estimates are too aggressive. They did get $33 million of free cash flow in 2020. So if they could do just a little worse in 2023 and then start to grow in 2024, the stock should go up a lot. It does appear the stock is really undervalued. Simply Wall Street is even higher than me. They're at $361 a share. They're saying it's 79% undervalued. Before the company acquired Waitr, it was a SPAC trading at $10. Once the SPAC announced an acquisition target, lots of people buy the stock and the price went up past $5 a share. Then all the people who owned the stock before the company went public want to cash in and monetize their investment, so they sell off. And the stock came down a lot. It was well below $1, I think down to 30 cents at its low point. The first time I did a video on Waitr in October, they were trading at 86 cents. And I thought it was a great value. I didn't see that much downside. I saw a lot of upside. When I went to buy the stock, Morgan Stanley bought a big chunk of it, and the fact that they bought the stock, so did a lot of retail investors. And that drove the stock price much higher. So I did get the stock at $1.18. And I bought 74,000 shares. And almost right away, my investment almost doubled, so I was really happy. But now I'm down a lot. The stock price keeps coming down. The two main reasons are Morgan Stanley sold a big lot of their stock, and their third quarter financials weren't so great. I still have my Waitr stock. I bought it on 10/15, 74,000 shares at about $1.19. I'm down $33,000. I'm not going to dollar cost average down. Even though I could, I just have way too much into the stock at this point. They have a negative beta, so the stock moves opposite the market. It's gone down 72% in the past 52 weeks, while the S&P is up 28%. The 52-week low is 75 cents, the high is 433, and the stock is on a major decline, trading well below its 50-day and 200-day moving average. This is a really popular stock. Over 13 million shares are traded on average the past 3 months. Of the 144 million shares outstanding, 115 million are on float, 27% are held by institutions, and about 8% of the shares on float are shorted. The reason their employee count went down so much is because they laid off all their drivers and moved them over to independent contractors, which is a huge cost savings, which will keep this company in business and hopefully prosper. If you put $10,000 into this company when it started trading, you would have lost 92% of your investment. There's been no insider buying, only selling. Luxor Capital sold 10 million shares, 1.7 million and 3.5 million. Another insider sold 200,000 shares. This person is the general counsel of the SPAC that acquired Waitr. The general public owns 72% of the stock, institutions 19%, and insiders 9%. The biggest shareholder is Morgan Stanley at 4%, Tillman Fertitta. He had that reality TV show. It was really good. He owns a SPAC that acquired this company. He has 3.5% of the stock, 5.2 million shares, valued at $4 million. Vanguard owns 3% and Jefferies 2.5%. Let's look at their financial ratios. They have a pretty good PE at 20, which is a little better than the market median, a lot better than the market average. PE is stock price over earnings per share. The way you calculate earnings per share, it's net income over shares outstanding. They have a really good price to sales, so their revenue is much higher than their market cap, and they have a really good price to book at below 1. Here's a list of their non-current assets as of 9/30/2021, according to their balance sheet. $4.4 million of property and equipment, this is net of depreciation. $3.1 million of capitalized contract costs. These are probably contracts with their payment processing company. $131 million of goodwill. Goodwill is the premium you pay when you acquire another company. $41 million of other intangible assets. So they have $170 million of intangibles. $4.7 million operating lease right-of-use assets. So they're leasing an asset from another company, and the value of that asset is $4.7 million, and $1.1 million of other. They have a lower return on invested capital of 1.3%. They can only cover 40% of their interest payments with their operating income. They have a 5% ROE, and they do have a good current ratio and quick ratio of 1.6. Let's look at their current assets. They have $44 million of cash, $4 million of accounts receivables. These are the funds due to Waitr from their credit card processing companies. $1.1 million of capitalized contract costs and $6.8 million of prepaid expenses. Let's look at their current liabilities. $6.1 million of accounts payable. This is how much Waitr owes other companies. $3.4 million of restaurant food liability. $1.7 million of accrued payroll. $2.3 million from insurance loans. $1.7 million from operating lease liabilities, and $19 million of other. They had negative $1 million of free cash flow in the trailing 12 months, but they do have $21 million of working capital. Working capital is current assets minus current liabilities. So it does appear they have enough funding to get through the next 12 months without needing to add debt or equity. The best way to look at ratios is to compare them to companies in the same industry. There are 235 companies in the same industry as Waitr, and these are the top 19 companies. Waitr is ranked 188th in terms of market cap, and Waitr is doing good in debt to equity. They're better than the average. Of course, they don't pay a dividend. They had negative free cash flow. The average in the industry is $338 million. Their market cap is $111 million. Average is $11 billion. They do have a really good price to book ratio, much better than average. Their PE is also a lot better than average. They have an amazing price to sales ratio. They're a tiny company, so their revenue is lower than average, although it's not that much lower because there's a lot of startups in this industry with zero revenue, which drags down the average. Since we do not have 5 years of financials, we cannot look at their annual 5-year growth rate. Their return on assets is low at 2%, and their ROE is also low at 5%. But at least it's positive and not negative. So to summarize, I have them trading at a 68% discount, and I really like what the CEO is doing. He made some major changes in 2019 to 2020, and he turned the company around. I think they would have went out of business if it wasn't for his two big moves. Changing their drivers to independent contractors and just focusing on certain cities that are profitable and exiting the cities where there's too much competition with the big delivery food companies, because they'll never be able to compete with Uber Eats and Grubhub. I do think there's a good possibility they can hit $1 billion market cap in the next 2 to 3 years. Even if COVID totally goes away, which I don't think it will, but say it does, I think there's still going to be huge demand for this company, because a lot of people do not like to go out and get food. They like it being delivered. And there's also a lot of times people are sick or they don't have a car. So this company fills that void. I rank their free cash flows 3 out of 10, their revenue 5 out of 10, and their ratios 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.